Hello to everyone. Welcome to the weekly webinar from ICM.com. Myself, my colleague Weil will be joining today. So it's quite interesting topic today. Like it's very interesting and very hot topic where we're going to discuss about all about gold. Where we're going to, I myself going to discuss about the trading history of the gold. And my colleague will be start about the current affair of the markets, gold rallies, and the risk involved in it. And mostly he'll be discussing more about technical perspectives also. So it's a very good topic. Let's start with that now. So when you're talking about the history of the gold, everyone knows that like gold is a mostly a safe haven for any investments. So gold has why you should know about gold. That's a few points we're going to discuss today. So gold is one of the key investment alternative for any investors in times of high uncertainty and risk. In case of any uncertainty in the markets or uncertainty in financial crisis, gold plays a major role in the financial markets. So investing in the gold could be a greater way to put your assets in secure, solid, and safe locations. So basically, the gold price is being quoted in a form of ounce. It's a standardized measurement as like other product has it. So it is mentioned in an ounce. It's a 1 ounce trounce is basically it's equivalent to 31.104 grams. It's a standard value of measurements. So among any commodities, it's easily like gold is a very accessible to the individuals, even to the individuals. Basically, like any individual can buying and selling, trading in the markets. Even except apart from the investor or big hedge funds or any institutional players, individual also has a more opportunity for to the trading in gold. And investors can buy gold, physical gold, or you can also purchase an ETF form or MTF format that replicate the price of gold, as well as gold trade in an option as well as the future markets. We say the COMEX. So mostly the online trading platform providing a COMEX price, which is a OTC price, which you are available to get enough liquidity to to buying and selling on any time number of quantity which are available in the markets. So basically, gold has also traded since an ancient time. So more and more people are investing in the gold via financial trading rather than actually going to the store or buying them. So what is very easily been become very familiar and facility to the online trading basically. So gold has been gradually become instead of buying a physical gold nowadays because of rally the market as gold become a safe haven. It's very easily have the facility to buy in online instead of going and buying in a gold merchant market or something like that. So when you're talking about gold, how exactly the gold has moved this much a rally in a number of decades. So the major factors which really affect the markets, like this is much reason the market has been rallied to the high. To if you see the today current markets talk or maybe a flash or coming to the markets on the gold is because of many factors. So one is that the economic data, which is inflation and deflation expectations of the markets. And other major factor is central bank policy and reserves. That's one of the big major important factors. Geopolitical factors, uncertainty in the markets. For example, take for any type of impact on the markets. So demand for liquidity, we can say normally we say supply and demand in the markets, which it has other factors, and jewelry and industrial demands are applicable here. So how it's also one of the major factors because industrial demands plays also a major role when coming to the bullion market, especially coming to the gold plays a major role here, and gold productions. So these are the major factors which gold has impact as the market moves this rally from the many years. When you're talking about gold, reserve as central bank reserve as also a major reasons. If many central banks has stored or reserved the gold as a safe haven in case of any uncertainty of the economic, like in case of any drop in inflation or deflations. So that gives more support for the central bank instead of carrying a currency format. Gold plays a major role for them. So here we're talking about, if you say the quarterly official gold reserve, recent one, for example, for the couple of times. So it's four major countries that plays a major roles. So for example, you take for United States of America, it's one of the major reserve. The highest reserve, and followed with Russian federations as well as China and also India. So these are major four current countries that had enough reserve to protect the economic by any type of uncertainty of their financial crisis. So when coming to the next, productions. So productions, if you say productions, like obviously, there are many countries which has produced gold. So among that, there plays 10 more major currencies are there. So here among these, like China plays a major production of tons of 383.2 tons. It stands at a top leading, top level of productions, following with Russia, which is a 329.5 tons. Australia plays a third, which is a 325.1. United States at 200.2. Canada also 182.9. Peru has 143.3. Ghana is 142.4. And following with South Africa is 118.2. Mexico at 111.4. And Brazil is 106.9. So these are major production of gold. Which also one of the factor like the demand which increase. So obviously the production level will be increased. So as you said, that as we see that China plays a major role, so sees that there is a big reserve production that be happening. So when talking about what are the trading mind to essential things to be concentrate on the gold trading, online trading markets, basically the buying and selling gold according to the quantity specified in the market. So you have specified quantity size are there to to buy or sell, or you can do trade in the market, which is easily available on the online trading. Next point is that leverage. Leverage plays a major role because when you're talking about the physical as well as compared with the online trading, in a physical market, for example, you want to buy 1 kg of gold, obviously you have to pay a full margin to buy the gold. But when coming to the leverage part, that means you pay only the part of the token amount to buy the gold, but you get the benefit of the total value of the contract. So this plays a major role of online trading. That was a reason that's become very popular. The online trading has become very popular among with gold markets. And there is a possibility of to sell gold when the price reaches the peak. That means like it's basically it has enough liquidity in the markets. Even you don't find any, for example, in a case of physical gold markets, like you feel like a market went in high peak. So you have to find a buyer to sell off. So in case of online trading, so there's enough liquidity where you can available the easy you'll get available on the price to sell off your gold on the online market, which easily have at a maximum a massive liquidity available in the markets. So these are major essentials on trading on gold markets. When I'm talking about comparisons or the history of the gold, how exactly the rally has been happened in the markets. When you say about, for example, in 1970s, the price was averagely trading on $36. The gold was trading at $36 per ounce. Gradually, when United States has kept the dollar off the gold standard and they kept a gold rate to be traded on a fluctuating market, from the time from 35 to $36, the market has been given to it came into the market as online trading, or maybe it as physical trading. It started fluctuating the price. So gradually, from the time of being like from 1970s the year of 1970, so the gold has become one of the safe, even there it's been the safe haven, because year by year, there are many factors which market has moved. The gold price has been moved, that we can say gold bullion market has been moved and gradually in different level of factors. When I'm talking about gold reaches 400, when gold reaches 500, when the market reaches $850 per ounce, there are many factors are there. When you're talking about 2003, the gold touches 400 level, breaks $400. It's mean because of 2009 or 2008, we can say it's because of the financial crisis happened in 2008 and 9, which feel that investors feel that gold has it's a safe haven. When I'm talking about other factors like war on Iraq, which also brings gold so to a higher level. And talking about 2009 and after that, like you can say 2010, 11 or 12, there are many reasons the market has given, because weaken the dollar, there was economic uncertainties happened in 2010. Even that has begun given the gold hits a fresh high, record high about like 2,200, 1,300, something like that. When talking about 2016, you know that the Brexit issues came, So that also given a gold hits in 2 years high, like 1,300 to 500 levels. So price keep moving in a one side direction on a gradual level. So when talking about from 2009 to 2020, has made a small table here, we can see I easily identify how the market has given a high and low, and where is the variation of the markets, how much dollars movement has been given gradually. So from 2009, we can see there's a $424.50 move in the year. In 2010, again, it's almost $386 per ounce. 11 it's 497, 12 it is 268. I can see there's almost like 200 to 400 dollars per moment in a yearly basis. When it coming to 2020, which is almost half of the year now, we can see almost $529.97 movement has been given in the market, and which is a low has marked as 140 and almost the high is 1981, which is a couple of days before it has been touched a new high. So the gold has a lot of comfort. Why we taken this table is that main reason to show how exactly gold has opportunity all the time, which really gives a value for the money, which really feel the safe haven for the investors. Even in case of for COVID reason, like gold feel the most safe haven for anyone. Like for example, in case of central bank or maybe for the individuals or institutionals, anyone, it feel the gold as a safe haven. So when talking about only in 2020, it's a clearly explained you that a big variation happens on every month basis. For example, like take for January, the low was 1571, and see that price now it is almost 1980, which is almost rallied to 304 $350 move. So we say for February it is almost 141. It's not easy. It's normally earlier time. If talking about 10 years or 15 years back, the gold obviously, I mean, which have a low range of move within a month, which is about 20 or $30. From 2009 to 2010, it started moving almost like 300, $400 per ounce movement has been seen. And you've seen in February in 2020, which is almost like rally of $100 average in a minimum of, and which is almost in a direction of giving a lot of fluctuation in the markets, especially in July. As of 29, you can see the market has moved $223.57 movements. So always gold has opportunities, and gold has a safe haven to everyone for the investor to be getting on this. So these are a small information about the gold, where my colleague will be joining to give a brief explanation about their perspectives, current affairs of the markets, as well as the technical perspective point of views.
Thank you, Sai. Hello, everyone. I hope you are all safe. I'm going to talk about the factors supporting the recent boom in gold prices and what are the risks for the current rally. And after that, we will have a look at the gold chart on the MetaTrader 4 platform. So first, as I mentioned during the past slide, some of the key factors for gold moves, or some of the main reasons behind moves in gold prices, are economic data, since they affect definitely the central bank policies. So we have two different types of policies adopted by central banks, either monetary policy tightening or monetary policy easing, where interest rates during tightening, interest rates would go up and money supply would shrink in the market, while when central banks are easing their monetary policies, they would be lowering their interest rates and they will be pumping more money into markets and lowering the borrowing costs. So this is currently what's happening now. We witnessed the coronavirus outbreak in early this year, and but it had an impact on the market, especially on the European markets and US markets in February, starting February and March. And this triggered central banks to take some additional key moves or key turnaround in their monetary policies. So this was one of the major supporters for the current rise in the oil and gold prices. So just wanted to go back to this slide, since these are the key factors, but now we're going to highlight the major we're going to highlight them in details. The start of the current gold rally didn't start just with the coronavirus. It started back in May 2019, when the bets over a turnaround in the monetary policy by the Federal Reserve were rising. The Federal Reserve started tightening its monetary policy in 2016, 17, 18, and 19, and also we witnessed a couple of interest rate hikes to reach almost 2.5% interest rate. So this was making bonds more attractive than the non-yielding bullion. So an investor would go to would buy a bond, and then he will earn a certain return on this investment. So it would be more appealing than having only buying the gold and betting or speculating that the price of gold is going to go up in order to make money, or the price of gold is going to go down in order also to make money if he's short selling. So what happened? They changed the concept. Since when the Federal Reserve started easing the monetary policy, they lowered interest rates by almost one full basis point since late 2019. So this had an impact on gold, and we've seen gold rising from almost 1270 to almost 1555 to end the year near 1555, 1550. So what came along during through 2020 and supported this boost was the coronavirus outbreak. We've seen that the coronavirus outbreak had erupted, as we said, it erupted in China and started spreading to the world. At the beginning, it was only affecting the Chinese markets back in January and early February. But in February, when it became more serious to the rest of the world, like starting February 20, we witnessed a meltdown in the stock market, especially in Europe and in the United States. So this triggered central banks and this triggered governments to or officials and authorities to take some steps in order to stop this spread. So they decided to lock down cities, and when they did lock down these cities, they disrupted the economic activity, and this had a serious impact on investors' sentiment over the global economic outlook. So we've seen a sharp drop in we've seen a sharp drop in equities, or a sell-off in equities. So central banks and governments had to interfere in order to ease the impact of this pandemic on the sentiment and stop the sharp plunge in equities and restore confidence to the markets. We've seen the Dow Jones dropping from almost 30,000 towards 18,000. So this was almost around 40% drop, and also top European indices were deeply in red. So this forced central banks and governments to take steps. Central banks lowered their interest rates to record and launched asset purchases programs. They also increased loans to states and businesses, and they eased restrictions on commercial banks and boosted the liquidity support. They've done all this just to try to ease investors' nerves, to make investors confident that there is someone here to help to help the economic activity, to help the market to recover from this sharp drop that will occur due to the lockdown. So they succeeded for a while, and we've seen a rebound in equities. We've seen a rebound in the market. However, investors rushed to the bond safety. The price of the bond went up, and on the contrary, its yield went down. So when these yields went down, they made the non-yielding bullion more attractive to investors. So an investor here would have the chance either to buy, for example, gold, or to buy a bond. On a bond, sometimes some of the bonds, they are paying interest rates. An investor is paying interest rates. Like for example, in Germany, they had negative yields, and in the United States, we witnessed a small uh, we witnessed rising bets over over a possibility that the Federal Reserve could adopt negative interest rates, but this didn't happen. So the previous experience in Europe supported the flow towards gold. Even though gold is not a yielding bullion, it doesn't give you a certain guaranteed return. But the current ongoing problems in the market would make would make gold more attractive to investors. Also, the fiscal stimulus by governments almost reached $10 trillion, which is very massive, raising investors' concerns whether these governments will be able to pay these debts in the future, or they will go through credit default, which also drove investors towards gold safety. The growing bets over fiscal and monetary stimulus in the United States, and the huge money supply from the Federal Reserve, the paychecks from Trump's administration, all added to the dollar supply and drove its value lower. So if we have a look at the slide, we can see here that the key the key factors that supported the coronavirus outbreak, its impact on the economic activity. Its impact on the economic activity forced central banks to adopt ultra loose monetary policy, and interest rates dropped near zero levels, and some central banks were considering adopting negative interest rates, similar to the European Central Bank, which adopted negative interest rates back then, and also the Swiss National Bank. So this was a possibility if the measures that were taken wasn't able to support the market or restore confidence, the Fed would have to take such a step maybe and go for negative interest rates. So this also had an impact on the market. The massive is also, as we said, central banks took their role, and also governments. They were after massive fiscal stimulus. All this led to dollar weakness. And still, at the current moment, the instability in the United States due to the coronavirus. So they didn't yet control the coronavirus. Every day we are seeing more and more cases out there. So this is also raising the concerns of investors over the economic activity that we witnessed in May and June. So in May and June, we witnessed economic indicators bouncing, signaling that economic activity is recovering. When we were about to end from wave one and numbers were dropping, but after the recent rise in numbers. So this is drawing again concerns for investors. Will this V-shape expected recovery is going to happen, or we're going to have a W-shape recovery? So all this impacted the dollar and also drove investors towards the safe haven, or the traditional safe haven gold. Also, geopolitical tensions around the world. We have a lot of geopolitical tensions around the world. We had last month we had clashes between China and India. Also, there are some unrest in the Middle East region. There is also unrest between Korea and the United States. Also between in the Middle East in general. So this is all driving investors towards more safety. Everyone's going for the gold safety instead of holding, for example, bonds, or holding the currencies of their own countries. So this is a key factor. Also, geopolitical tensions, U.S.-China tensions. We've seen the impact of U.S.-China trade tensions earlier on the markets. It raised uncertainties, and also it raised concerns over the global economic outlook, since the United States and China are the two largest economies in the world. So any clashes between these two would affect definitely the economic activity, and this could lead to a change in central banks policies. So also this could be supportive for gold prices. And all these factors that we mentioned, they supported the flow towards the ETFs that replicate the price of gold. We witnessed during the first half of 2020 a record flow to gold ETFs, ranging for around almost $40 billion flow to these ETFs. So these are the key factors that are supporting this rally. One of the major factors, and we're going to see a chart that would definitely give you the exact idea about this rally, is inflation expectations. Due to this massive stimulus, either monetary or fiscal, money supply is growing heavily in the markets. So all the central banks are pumping money and pumping money. And the money supply is rising in the markets. So since money supply is rising, this will trigger concerns over inflation. So definitely, when we have more money supply, it will affect the purchasing power of the currencies that we're holding. And definitely, when the value of these currencies drop, investors would look for an inflationary hedge in order to keep or to preserve the value of their money. So one of the major factors that investors are rushing to gold is that they are expecting a huge shoot in inflation following all this massive pump of money in the market. So this is one of the key factors. Investors are looking for inflationary hedge, and the traditional inflationary hedge usually is gold, and that's why we're seeing, for all these factors, we are seeing gold trading at this record high. We're gonna go over some of the charts that supports what we've said. We can see in front of us the chart of gold versus the coronavirus, the confirmed cases around the world. As the confirmed cases are rising, we can see also gold is going to a record high. As cases became steeper, also gold shot higher in a much steeper way. This is another chart also. We've talked about the near zero interest rate medium, or the negative, also negative interest rates. This chart shows the relation between gold and US 10-year Treasury yields, which are used as a benchmark for the bond market. In this blue color, we can see the drop in yields, and the candlestick chart is showing the gold chart. It is a weekly chart back since April 2006, and we can see the inverse proportion between the 10-year yields and gold. And here it is short. It is very clear. This was back in 2019, when I mentioned earlier that back in May, when the bets over the Federal Reserve turning from a hawkish tone towards a dovish tone affected the market. We can see that yields dropped. From the 10-year yields were around 3.2%. They dropped towards near 0.5 level. So even lower. So this had also made gold more attractive to investors, and gold prices shot higher from almost 12,080 towards around $2,000 an ounce, and yesterday almost 1980. So the chart is very straightforward. You can see the inverse correlation between the two. Also, gold and the dollar index, we can see, as definitely, since gold is priced in. So for example, we have if gold is priced in euro, we wouldn't have seen the same rise that we saw last week, since the euro was also gaining against the dollar. The dollar was the weakest against currencies and against these commodities, so that's why we saw gold against the dollar shooting higher. So this is also explaining the relation between the dollar index and gold. So it's an inverse correlation. But recently, like during 2018, and mid 2019, this correlation was a little bit affected, so it wasn't very accurate. There is something that everyone might be concerned about, and they might say that back in March we witnessed a sharp drop in gold. This drop that I'm talking about, we witnessed a sharp drop in gold in March despite the coronavirus outbreak. Definitely, when I explained this before during a webinar, and I'm gonna repeat it. What happened back then is that there was a real sell-off in the equities market. So if you have a portfolio that you're holding equities, you're holding bonds, you're holding cash, and you're holding gold. So if you used your cash to cover the losses for equities, and now you're left out with bonds, gold, and equities. So what's the next commodity? What's the next asset that you're gonna liquidate in order to support your position? So definitely you're gonna look to liquidate gold. So that's what happened back then. Investors' demand for liquidity. The demand for liquidity drove gold prices lower, and this could be one of the risks. We're going to talk about the risks for the current rally. This is the chart that I talked about a while ago. This is gold against the TIPS. TIPS are the Treasury inflation protected securities. These TIPS here, they are usually used by investors in order to preserve the value of their money if inflation was going up. So in other words, uh, they protect portfolios from inflation, as well. They protect the portfolios from the inflation. So if the inflation is going up, the TIPS, or the Treasury inflation protected securities, will adjust their price to the upside in order to hedge your risk against inflation. So if you can see the chart in front of us, gold and the TIPS are definitely moving together. They are having the same pattern. This is the daily chart back from November 2019 until now. This shows when the central bank, the Federal Reserve, turned from being a dovish to a hawkish, from being a hawkish to dovish, from tightening monetary policy to easing monetary policy, how gold prices edged higher. Raising the step of the Federal Reserve raised the chances of inflation, of higher inflation. This triggered investors' rush towards inflationary hedge. So they bought the TIPS, the Treasury Inflation Protected Security, and also they invested in gold. So you can see here the market moved exactly the same. The TIPS and gold, they are moving together, and currently they are all trading at a record high. So this is one of the key charts that explains that one of the key factors for the recent or the key reason behind the gold rally, the recent gold rally, is the hedge for inflation. So this is these are the key factors or the key supporters for the rally. What are the risks to the current rally? COVID-19 vaccine. We heard Jerome Powell, the Federal Reserve Chairman, stating a couple of times that if the economic activity will be restored to pre the pandemic levels, the Fed will start considering to tighten the monetary policy, to rethink of maybe stop the asset purchases and maybe raise interest rates on the longer run. So this is one of the key needed things in order to restore the confidence in the market, to restore the confidence for central banks that the economy will be right on track. So if currently, for example, there will be a reliable vaccine, people will be more confident to go out. And if they are more confident to go out, they will start in supporting the economic activity. They will start spending again. They will go to work again. Companies will be ready to invest again and to spend more money on expansion, and this will definitely return the economic activity towards prosperity, and this will be supportive for central banks in order to start to tighten their monetary policies slowly. So definitely, when they tighten the monetary policy, they are reducing the money supply in the market, and when the money supply is reduced, usually this will reduce the risk of inflation, and they could affect the rally of gold prices. So that's why also I mentioned a change in the Federal Reserve tone. The Federal Reserve currently, in the past meetings, the Fed announced that interest rates, the monetary policy will remain accommodative. We witnessed the Fed relying heavily on the economic data. But despite the fact that the economic data or economic activity improved back in May and June, the current rise in coronavirus cases in the United States, the soaring numbers of coronavirus in the United States, will definitely make the Fed think a couple of times before changing the tone, since this will continue to impose downside risks to the economy and to the economic recovery. So this is a key risk to the current rally if it happened. Demand for liquidity to cover any sharp drops in equities. So if the currently we can see that the equities are holding and we're moving sideways, uh, we aren't witnessing any fear sell-offs like the ones that we witnessed back in March. So this maybe since investors have more confidence now, there are much money also. Central banks and governments are supporting, are trying to ease the impact of the coronavirus on their economies and maybe support investors' confidence. So currently also we don't see like a solid a solid possibility that this could be happening anytime soon. So that's why also this remains a low risk to the current rally. So these are the key risks for the current rally. Now we're gonna move to the MetaTrader 4 platform in order to talk about to check the chart of gold and maybe set some forecasts. So we're gonna go back to we're gonna use the weekly chart. So as we mentioned that this sharp rally started back in May 2019. We can see here back then gold was trading in a tight range for almost 3-4 months, and here the ATR was dropping sharply. So the average through range indicated that the volatility is dropping, making more gold less attractive. Investors are less excited to invest in gold, and dropped the volatility of gold. However, back then the drop and the sudden drop in the GDP price index, which is, and also the PCE, which are main gauges for the Federal Reserve and following up on inflation, uh, were disappointing to the downside. So this also raised the bets of the Federal Reserve changing its monetary policy, and that drove the demand for gold. And we witnessed back then the rise for gold. In almost 2 month, gold rallied from 1280 towards 1550 and ended the year almost around this level. This was the impact of the coronavirus here back in February. We witnessed also a rally at the beginning of the virus, and then here the demand for liquidity triggered this sharp sell-off on the weekly chart, triggered the sell-off from almost 700 1700 levels to 214.50, which was if investors quote a buy here near the support, it was one of the greatest entries ahead of this rally. And here, since central banks adopted their measures here and they announced their asset purchases programs and also lowered their interest rates in this period here between mid-March and end of March, this gave solid ground for gold to rally higher, and this continued here to the upside. And currently gold is trading near its record high. We're trading now near 1950, definitely above the previous record reached in 2011, which was 1922. Now if we're going to look for invest for gold on the long run, there are top hedge funds around the world, and also big banks. They are advising that gold is going to 2,300, 2,500. Some of them say 3,000. So this could, since they are seeing that the Federal Reserve will keep the current policy for a while, and there are many factors that increase uncertainty in the market. And since uncertainty and stress is available in the market, investors will still prefer gold prices. But a main risk to the current rally, also they mentioned that it would be any turn in the tone of the Federal Reserve. So that's why you better watch out for investing in gold, or looking for very high levels in gold. So on the short run, if investors want to trade gold on the short run, maybe they have to look for a little bit of a correction before jumping in with the trend, since the market moves from almost 1810 towards 1980, almost 10% in less than a week. So maybe this could trigger some corrections on smaller time frames before another leg higher, another move higher. So that's if you are willing to trade gold on for a short period of time. Let's now, if you are long on gold and you are looking for what are the levels that you could look out for, since we don't have any previous history, since we are trading at a record high, we can only use Fibonacci extension levels, which could which could support our the levels to target. Also, we can use the psychological levels. You have the 2000 psychological level, so definitely this could be could be considered as a key level. If you are using the Fibonacci extension, so let's say we're gonna go for this top. So we're gonna choose the previous top, 1980, the top yesterday's top, and we're gonna go for So we're gonna go for the 123.6 extension. So this would be around $2,050. We said that $2,000 could be a psychological level, holding some orders definitely there. And after that, the 123.6 Fibonacci extension could come in at 2050, almost 2058. So this could maybe trigger some resistance in the market. And if you are looking for a place maybe to exit your longs, you could consider the 123.6 Fibonacci extension. For the recent move from the recent bottom back in 1674 to 1980. So this could signal that the market could rally towards almost 2050, 2050, 2060, which is the 123.6 Fibonacci retracement. On another note, if If we are looking for a reversal, also we can use the Fibonacci retracements and not Fibonacci extensions. So we can go for, so as the market's going to correct for almost 23.6, it would trigger a drop towards yesterday's low, which was around 1907. So you can see here, if we go to the hourly chart and we set the Fibonacci from the bottom to the top, you can see that the market retraced exactly 23.6 yesterday of the recent high, and now currently we are trading near the middle range between the 23.6 and the 0% or the 100%, the top 1981. So the next level that you can look for is 1865. If we were able to trade back below 1910, these could be the correction levels if you are awaiting a correction, maybe to join the trend, or you are holding some short positions and you are looking for targets on the downside. So these are the key levels to be highlighted on gold: 1865, 1910. On the upside, definitely we have yesterday's high, 1980, 2000 psychological level, and 2050, 2060, which is almost around the 123.6 Fibonacci extension. Uh, some of the traders, they're looking at indicators. Uh, so so here, if we have the Bollinger Band, we can see that during the past couple of hours, the volatility in gold dropped, driving the bands closer to each other. So this could signal that we are looking for a breakout currently. So on the smaller time frames, you have to watch out for any breakout above 1964 level. And maybe this was a false breakout during our webinar near 1945. So this is the range that we've been trading in for the past couple of hours. So watch out for any break above this range. Maybe above this range, above 1964, could trigger a move towards the previous high of 1981, and below this level could trigger a drop towards the 100-hour exponential moving average, which was supportive back yesterday, and it comes around 1925 levels. So this is if you are using the Bollinger Band, and if you are assessing the volatility of gold using the Bollinger Band. If we go for the daily chart, we can see that the bands, they are very wide, and this could signal that maybe we could have some sideways move ahead of moving higher again, or we can have a little bit of a reversal. Currently on the daily chart, we don't see a reversal signal. We have this doji candle, which is almost a neutral. Uh, so definitely a trader would have to wait for a reversal signal before shorting the market or going opposing the trend. The RSI is in a very in the overbought territory near the 90 level, which is almost definitely high relative to the previous overbought signals. But here back in January, the RSI reached almost 90, and after that we witnessed another divergence in RSI, witnessed another high, a higher high, and the prices after that corrected. If we go for the weekly chart, you can see that the RSI in is still low relative to the previous two peaks done in August and in February. So definitely you can't, when the market is trending, you shouldn't rely on oscillators in order to pick tops. So be cautious if you are using oscillators in order to pick the top in gold prices. So definitely this is almost what I wanted to say on the chart. He The volatility is dropping for the past couple of hours. Definitely, we have the Federal Reserve in almost less than 4 hours. So it is a very risk event to the market. The market is currently expecting nothing much from the Federal Reserve, so no changes to the policy. But definitely, if Jerome Powell will talk about interest rates or the future path of interest rates, this could create more volatility in the market. And that's all mainly for this webinar. If you have any questions, please write them down so we can support you. I would just like to remind you that all the information, analysis, news, and opinions are only for educational purposes and shouldn't be taken as a signal whether to buy or to sell any financial instrument, and the ICM doesn't provide any advice. So if you have any questions, please write them down. Okay, so someone is asking how to be a full-time gold trader. There is definitely nothing called full-time gold trader. Now you can, it depends whether you are trading, for example, gold, you are trading like long swings in gold, then you have a trade and then wait for it. Or if you are looking to scalp the gold price action, this will also require from you more basics of scalping on how to scalp. You definitely need to have a strategy, scalping strategy, and this would could be very time consuming to you, and also this could require a lot of effort, emotional and it's not a really easy thing to just focus on one item and just scalp it all the day, for example, or a trade to have some daily trades on it. So definitely when the market is volatile or highly volatile, this could increase the risks of trading. So you have to be cautious when doing so. Okay, so there are a couple of nominated vaccines that they could be reliable in the future, but definitely they are going after a couple of trials. Moderna started its biggest trial on 30,000 volunteers, so this is very promising. The White House health advisor, Dr. Fauci, he stated that we could have a vaccine by the end of fall 2020. So there are just all estimates and studies currently, but there is nothing solid about having a vaccine anytime soon.
While there's a question,
Uh, we can't just rule out that the price is not gonna maybe correct or reverse. This could have some impact also. If the economic activity was restored despite this outbreak, so as you know, the governments they didn't take like serious lockdown measures this time like the previous time. So maybe this will have a little effect on the economic activity, and maybe this also would support the central banks to be less aggressive on their on easing their monetary policy. So maybe also this could have an impact on gold. So that's why we mentioned any turn in monetary policy stance. So this could have an impact also. So we can't say just if we are not going to have a vaccine anytime soon, gold prices will continue to rise. Definitely not. It depends. There are a couple of factors that are driving gold prices higher, and among them, as I explained, with gold versus tips, among these factors is inflationary hedge. So if the risks of inflation uh, reduces or lessens, so this maybe could trigger a downside move in gold, and not a continuous uptrend. Okay, perfect. I believe this is it for today. Sai, do you have any words to add?
oh, great. Thank you, everyone.
Perfect. Thank you, everyone. Stay tuned for any updates from Federal Reserve on our Telegram channel. Maybe it could have some impact on the market, so watch out for trading. Always make sure to follow your risk management techniques, and thank you.